Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Thursday, the 16th of September, 2021. And thanks for watching as we're going to go through our headlines of the day, or what we're paying attention to at Blanke Schein Wealth Management, so you should be too. Thanks for watching. Our first topic, we're going to talk about the CPI. Earlier this week, the CPI came in a little lighter than what Wall Street and analysts and economists have expected. That being said, it still was over 5%, and that still is a hot number, if you will. Especially if you determine what we like to say here at Blanke Schein Wealth Management, when we create your financial plan and we basically build the investment portfolio specifically designed to you and your plan. So it's a customized approach for every client. We look at your, not the CPI, the consumer price index or the inflation rate. We look at your CPI-U, what you are spending money on, and what you and I are spending money on is very different than what's in the indices that kind of makes up that weighted average. So let's talk about that, right? Maybe healthcare, maybe education, maybe, they even took out food and energy. And I'll tell you, if you look at energy up 42% year over year, you can't say that we're not using energy in what you and I consume. So we always discount the CPI, even though Wall Street sort of liked that number and the market was up earlier this week as a result, that one day. That being said, the markets are now going through the summer to fall transition. And so it's a lull in sort of earnings expectations, a lull into, obviously with us supply constraints that we're seeing. I don't know if you know this, but there's over 60 different ships off the coast of LA port right now in Long Beach that are waiting just to come in. So there's a bottleneck logjam there. And think about that. That's all consumer goods that's going to go into the GDP, the spending and consumption. If those goods don't make it in the stores in time to be consumed, that's going to reduce or shrink our GDP, gross domestic product. That's almost already factored in. We've talked about that several times before. So the economy is going through sort of a contractionary period of time. Therefore, we think anticipation of what we're seeing is earnings are going to sort of come in a little bit lighter than expected over the third quarter. But we have to wait and see how this plays out. This is all factored into different COVID, coronavirus sort of things that are happening not only here but around the world, and we're seeing those supply constraints. So this could take another 6 to 12 months, maybe even longer than that, to sort of normalize our economic data and our earnings. But like I said before, earnings last quarter came up over 15% year over year in terms of an increase of over even 2019. So earnings are growing in spite of all of these sort of bottlenecks that we're seeing in the global economy. But the CPI-U, like we said, has to be factored in higher than what's ever reported by the government, because I believe that their factor always skews to the downside or low side because it's favorable to do so. That being said, let's talk about the other headlines that are out there. The biggest right now happens to be the taxes are going to be going higher for 2022. The good news is starting 2021, the conventional wisdom was, since all three branches of Congress, or the White House and the House and the Senate, so Congress and the White House, the conventional wisdom was that taxes will be increased retroactively for this calendar year. Well, we're now in the third and going closely into the fourth quarter very shortly of this year. To do retroactive is almost impossible. In fact, it's probably very improbable. So now taxes being raised for 2022 is very more pragmatic and more practical on a go-forward basis. That being said, what areas that we're seeing in Congress? Well, there's some hiccups. There's some sort of you have to bring the progressives and moderates together, and that's sort of where the horse trading is happening right now. Remember, they use the word infrastructure as looping in a human infrastructure. So they're trying to get the taxes all across the board for everybody. They're saying just the rich, but that's not the way it really shakes out. They're looking at different ways to do this, but they're coming up with the challenges. Again, Joe Manchin of West Virginia, a senator, is sort of dragging his feet, and he's a Democrat, as to what he sees. And on the other side of that, you got Bernie Sanders. And in the middle, you have everyone else. And so those two sort of have to be happy for Congress to actually progress and get something through. Now, I mentioned SALT and SALT. Well, there's two different things that we've seen as it relates to taxes. This week, there's the SALT conference, and Anthony Scaramucci, who had a brief stint with not only Celebrity Apprentice, but also the White House itself under Donald Trump. And then that spun out of control, and those two guys don't like each other. But that made for great TV drama both ways, if you will. He's also the founder of the SALT Conference. And that SALT Conference is actually a real deal. It's where all the hedge funds get together, all the sort of the great minds of Wall Street, big money on Wall Street get together, and they sort of share sort of news-breaking headlines. Or even watching, if you watch CNBC, they're there live this week reporting because it's so impactful. And so they actually had, earlier this week, they had the White House Chief of Staff, Robert Schein, who confirmed his point yesterday at the SALT conference that maybe the size and scope has to be cut down, as well as the duration of spending in terms of the $3.5 trillion package that they were potentially to see. Now, as Dan Clifton points out from Strategist and all the research that we're pointing to as well, and that we're seeing, is that don't get hung up on that top line number, okay? That's really meaningless. What we want to focus on as it relates to investing, as it relates to taxation, and coming up with smart tax strategies is the calendar years on a go-forward basis, sort of the vintages of what goes into effect when the spending happens, or when sort of capital gains gets lifted or raised, or so on and so forth. We know that there's over an 82% right now probability that corporate tax rates will be going up. And if that happens in terms of the current proposed what the House has, we would be the third highest country in the world in terms of a tax rate. So that would be not the smartest strategy on a go-forward basis. I know there's a lot of things that Democrats sort of have on their agenda to pay for, but I think this, Joe Manchins are taking sort of a pragmatic approach, while the Nancy Pelosi's are trying to basically go full throttle, full steam ahead, because they know that the time is really not on their side. So they have to basically rush to the finish line, get everything in that they possibly can. And as Nancy Pelosi famously once said, you got to pass the bill before you know what's in it, right? That was something she actually did say on one of the previous Congress bills in the past. You've got to pass it first, and then you got to know what's in it. And that's essentially something that she's gone by for many years in Congress. I don't know if it's the prudent approach, but here's what's interesting. To get sort of the both progressives and moderates, like the Bernie Sanders and the Manchins, together on the same sort of page and to sign off and endorse this, whatever's proposed. And we're not going to spend too much time on what's being talked about, because between it's sausage making, what happens now to when it actually comes out, so much could happen in terms of the horse trading again. But what's really interesting is that the SALT conference I spoke about originally, it also made reference to the SALT tax, state and local tax. And ultimately, if you recall, in 2017, in the tax code change by Trump, he took away the ability and capped it to $10,000 to basically for you to write off on your primary residence your taxes. And if you're in California, the real estate market is super high. So to have $1 million home, while it sounds outrageous to anyone else, it's literally going to be $1 million home everywhere you see in California for the most part. And if you have 1.25% tax, that's over $12,000 to $15,000 depending upon the price of the home. But you can only write off $10,000. So there's a little bit more you can't write off. So the irony of all ironies right now, according to the research right now coming from Washington, is that in order to get sort of the Democrats on board fully, they're going to have to raise the SALT exclusion in California and New York, the two highest taxes for states of those contractual or the districts too, where they have sort of it's just crazy. Like, so you want to raise taxes on everyone else, but if you're in New York and California, you need to raise your exemption or your deduction on your $1 million mansion. And if you go back to those in Congress that actually are voting for this or trying to get this passed, because remember, Trump repealed this and brought it down to you could do whatever you want before, write it off, and now there's a cap at $10,000. So it's kind of like, listen, I'm going to pass all the tax hikes on the rich, but I am also in Congress and I own $1 million home plus. I want to write off all the taxes. I mean, why wouldn't I, right? From everyone back east to everyone here in California. I mean, the irony that's happening and playing out is kind of just frustrating. But we really want to get to the brass tacks of why Congress wants to spend so much, right? Not only to get their agendas through and sort of a payback for constituents and districts and so on and so forth, but they're also looking at sort of keeping the economy going. So the fiscal policy of new presidents and the GDP. if you go through it, and again, the strategist report had it, and they actually had a pretty good breakdown. I don't know if you could see this, but they had a breakdown of all the presidents and essentially what they've been able to do. But everyone goes back to Reaganomics, and whether you were a student of Reaganomics or not, you can't disagree with President Ronald Reagan's fiscal policies, right? And again, remember, Trump took the same team and he put Steve Moore and Larry Kudlow and a whole bunch of others. He just recycled Reagan's team. And again, we're still in the Trump economy as it relates to taxes because we haven't changed the tax system. That's why markets are up. That's why corporate profits are up. So a lot of things are still moving along. But if we go back to the GDP right now, the average under Ronald Reagan was 2.89% on an average, a 4-year average, and he was there for 8 years, so he grew it tremendously, our economy, under Ronald Reagan. And he tops the list by everybody. No one's even coming close right now. Even Trump only had a 1.06% under his 4-year span. And why that's important is because our fiscal policies are about spending or stimulus or sort of gearing the economy to sort of grow and keep us competitive in the US versus the world. And obviously, there's always things that bumps along the road, which is recessions or even wars from time to time. So kind of derails some of the presidents that you've seen in past. But for the most part, it's important that fiscal policy, again, Biden's plan right now works its way into what he proposes will keep the U.S. growing and on the right path to keep us competitive on a go-forward basis. But Congress, the House, and Senate have to come to terms, and that's going to be a lot of weeks and a lot of late nights to come. And I can almost with certainty say it's not going to happen until the late last night of the final minute of the final day of when their deadline is, that they actually will then just jam everything into it and say, okay, we finally have discussed it enough and let's just go with what we have. And that's when we really then pass it and then we read it to find out how we go forward on a go-forward basis to plan for our clients, to see what really shakes out in the end. So that's sort of a big long-winded story today of where we are sort of checking in what we're paying attention to. But we really appreciate you paying attention and following along, and we'll have more next time. Take care. Have a great day.